Hello, everybody. This is Mike Preston at New Harbor Financial. We thought we'd provide a brief market update this week. Our good friend and partner, Adam Taggart at Wealthion, is busy this week. His mom, sadly, is seriously ill, and he's been tending to her. And in light of that, we thought we would offer a brief update and send it out to our clients and other people that might be interested. So, what's going on? It's been a pretty crazy week. The Fed met on Wednesday. They decided, as widely expected, not to do anything this time. They're on pause. The market sees maybe one or two more rate hikes in the future. All eyes are on the Fed all the time. And it seems like that's what we talk about maybe 90 to 95% of the time, and probably for good reason. Because for over 10 years, the only thing that's mattered is what the Federal Reserve says and what the Federal Reserve does. The market's been all about liquidity. We think that era is likely ending at some point here soon. Inflation is now out of the bag. The average person knows about inflation here now, and I'm not so sure that the Fed is going to be able to get away with the same quantitative easing, knee-jerk response that the market's seen for so long, but time will tell. Anyways, it was pretty much a non-event. No change. The markets were pretty subdued afterwards. There was some volatility right out of the gates, maybe for an hour or two. But this market has been on a tear, and we want to break down some things that we're seeing, share some comments, tell you what we're doing in the portfolio right now. You take a look at the S&P, and I'm going to go ahead and share a chart here in just a minute. The S&P has absolutely been strong and on a tear, like I said. Here's the S&P. That chart come up. The S&P has been in this downtrend channel since the top, January 4th of 2022. It's been a pretty well-contained drop, roughly 20% in 2022, but it bottomed on a dime in October, and it's been pretty much in almost a 45-degree angle, a little less than that, but it's been a very robust bounce since the October low. Been relatively frustrating. Our style is to look for key points to add exposure. We did some back here in October with a hedged entry, and but it's been really off to the races since. We got out of that position pretty early on, and we've been doing some other things, but really haven't been able to take a bigger bite out of the market, to take a bigger position because of the backdrop that we're dealing with. We've got a macro backdrop that's very extreme and has us very concerned. I'll get into that a little bit more in a minute, but take a look here what's happened. We can't deny that we have seen some improvement in market internals, and what this looks like here is a breakout of a consolidation area. And this has been a big week for the S&P. Here, as I record this, it's Friday, expiration Friday, and this has been a big week. So a lot of people are shaking their heads and saying, "What the heck is going on? This looks like the real deal." And a lot of people are getting FOMO or fear of missing out. So I want to talk about that because this market has been all about psychology, and I believe that it's very important to try to stay as even as possible. Psychologically, this market will suck you in and kick you out at exactly the wrong times. So let's just take a look at a few other things that we're looking at here. Short term, like I said, indicators are improving, but the issue is at the same time, we're also seeing short-term contrarian indicators get pretty extreme. For instance, the call volume yesterday was off the charts. In fact, I think it was the highest call volume on record, or at least in quite a long time. This chart shows the S&P call volume. It goes back a good 17 years or so. And you can see that post-COVID, call volumes have actually increased substantially, and the trend is up. But what we saw here recently is just an insane amount of call buying. Now, sometimes call buying is a contrarian indicator, and sometimes the market can continue despite a surge of call volume. But near term, we can at least say that the market has some near term euphoria that should at least get us to stand back and say, wait a minute, What's going on here? Are we a little bit over exuberant? And it seems like we probably are. Also, if you take a look at some really short-term contrarian indicators like the AAII, American Association of Individual Investors, bull to bear ratio. This chart only goes back a couple of years, so I know it's not a really full long-term picture, but short-term individuals are getting bullish. So there's lots of call buying, individuals are getting very bullish, and I can't help but share the macro backdrop. And I know that macro is not a very good timing indicator. Valuations are not a very good timing indicator, but take a look at this chart, one of my favorites that John Hussman puts together, someone that we have a lot of respect for. This chart goes back 100 years. It's one of the reasons why I like it so much. It's such a wide swath of history. And take a look at the S&P 500 index. That index, absolutely goes up over time, but there's times in the S&P where you don't go anywhere for quite a while. The S&P topped out in 1929. It didn't hit a new high until 1954. That's 25 years to get back your money, and that was a 90% drop as well. Now, we can't predict if anything like that would happen again, but it certainly could. In 1966, the market traded at around 1,000 on the Dow, and in 1982, it traded at around 1,000 on the Dow. This chart is the S&P, but it's very similar. That's 16 years that the market went nowhere. But the green line here is pretty interesting. John Hussman does a good job of measuring valuations because the return that you get on an investment is all about the price that you pay for it. Nothing else really matters. A lot of other things matter in the short term. In the long term, nothing really matters other than the price you pay for something. Valuations, as John Hussman has measured them, have almost never been higher, except for the very top, of course, in January of 2022. This happens to be non-financial market cap divided by corporate gross value added. It's somewhat similar to stock market capitalization divided by GDP. This particular valuation metric is one of the highest, actually the highest correlated, according to John Hussman, to subsequent returns in the S&P 500. That green line here is the level that the S&P 500 would have to trade at to return 10%. Approximately 10% over the next decade or so. I know it sounds pretty crazy, but that means we'd have to be down at 16 to 1800 on the S&P to expect 10% returns. And a real challenge in this environment has been that the market has been relatively permanently overvalued since 1995. And the Fed and other central banks are doing all they can to keep it there. That's really the name of the game. We have what seems to be a permanently high plateau that refuses to correct, and each time it does try to correct, it gets rescued by central bank money printing and quantitative easing. At the bottom in 2002, we didn't even reach long-term, quote-unquote, average valuations. At the bottom on March 9th of 2009, we kissed average valuations or equilibrium for a very short period of time, but of course that didn't stay that long either. And then we went on to just a relatively insane period that we're living through now. The next 15 years have been TARP, QE1, QE2, QE3, and of course there's talk of further quantitative easing and when will the Fed pivot. So we don't know. We don't know when the Fed will pivot, although I suspect the Fed will pivot at much lower levels than the S&P. I think the Fed needs some kind of accident. We'll see if that happens. But I would not be expecting this to continue without some type of correction. As I said before, short-term, the indicators are looking a little bit better. Long-term, the indicators look terrible. That's what's so hard for investors here, is what do you do? It's really a forced market. It's all about psychology. Money printing, or the so-called wealth effect, drives people crazy to some extent because they can't stand not doing something. And for a lot of those years of the last 15 years, we had 0% interest rates to deal with. Now we finally have something different. We have 5% short-term interest rates to deal with, which is wonderful. So our message to people, whether they're not our clients, is to strongly, substantially reduce risk, get equities down. We would suggest less than 30%, raise some cash, put it in treasury bills or short-term CDs, make sure you have some gold, and you wait for better prices. You are getting paid to wait. There is an alternative. There's a few other things that I wanted to mention here, just some notes over the last week, some conversations and things like that we've been having. There's a lot of FOMO out there, fear of missing out. A pretty common theme now when we're talking to people is, I don't know how long this market can go. It doesn't make sense to me. What do I do? I've got fear of missing out, or my neighbors are making money and they're starting to talk about it again. That's the unfortunate part about this time that we're living through, is that it's all about psychology, and it's being used in a way as leverage against us. I would say don't fall prey to that. Have a sound plan. Don't be afraid to sit in cash and wait for an opportunity. Talk to somebody if you want to talk through your urges or your feelings about this. I think that we're really good and very in tune with the psychology of what this market has done to people, frankly, what it's done to us. I think that we can share our journey through that, and I think we can offer a perspective that we've gained with experience. So fear of missing out is very prevalent right now. Be careful. Don't make any quick decisions. Give us a call, shoot us an email. We're happy to talk to anybody, whether you're not a client. We'd be happy to have a quick chat with you. This business slowing. I don't have any charts for this, but we've had numerous conversations over the last month with people in the transportation industry, the RV industry, wire and cable, heavy construction equipment. All of these industries are slowing. And what happens is the orders slow first because the people they sell to want to draw down their inventory, and they're not so sure about the near future either. So these industries seem to be slowing. It's a little early to tell. It's a bit of a warning signal. And perhaps we'll need to dig a little bit more into the data and see if we can find a trend. But right now that seems concerning. So we talked a little bit about some ideas that we're having. Let's take a look at a couple other charts, and I'm going to bring those up right now. So this is the S&P 500, which I've already talked about. It seems to have broken a little bit out of this channel, and it's going to be a really strong week. We'll see if there's any follow through next week, but other than putting on a one or two small hedge positions, we're not going to jump into this with both feet. We're very cautious about this breakout. We may be proven wrong. I don't know, but it's a fairly large breakout, and it's been a very narrow move so far. It's starting to widen a little bit. Some things like biotech have decent looking charts, and industrials. Industrials are old, basically old school Dow stocks. Look very good. There's a nice breakout there. We may consider something in all of these areas, and we may even consider a hedge position in the broad indexes. So we'll see. It's something we're studying closely in the investment committee. So let's take a quick look at gold here, because gold really is, in my opinion, the best looking chart out there. This is a 20-year chart of gold, and it went through a 12-year consolidation and then a high level kind of pennant formation. Then it broke down, and then attempted to break out again. And what we have here is a triple top, and we'll see if this triple top holds. Normally they don't. I personally think that gold is going to break above 2,000. And once it does and confirms that and stays there for a little while, I think we'll start to move right up to 2,500 or so. So gold is really one of the best looking charts, if not the best looking chart that we're looking at today. Gold mining stocks, ironically, are or paradoxically, I'd say, are lagging. So gold stocks, if you look at GDX, for example, should be up in the 40s or so. Why is it down here? I don't know. There's many times where gold stocks have underperformed gold. There's many times where gold stocks have outperformed gold. We're going through a long period where gold stocks have underperformed gold. Now, perhaps there's something going on. Perhaps there's worries about government intervention, or perhaps the market is just asleep. If gold breaks above 2000 and moves higher, like I mentioned earlier, it could. I think that gold stocks are going to move quite a bit. We'll see. We have a roughly 10% position in our portfolio in gold stocks. Normally, we have a hedge. We often carry a hedge on a portion of that position, just in case we have a big drop in the S&P. Gold stocks themselves could fall hard. So we want to make sure that we have some type of protection there. But gold stocks are one of the better opportunities, in my opinion, today. So having said that, we still remain very heavily in cash equivalents at the moment, a little over 40%. We might put a little bit of that to work in the next week or two, but I think it's safe to say we're not going to jump in a big way. I can't deny the short-term picture looks much better than it did just a couple of weeks ago, but we want to continue to pick our spots, have hedged entries into the market, and we're okay if we miss out on some of the upside. There's really no way to have your cake and eat it too. And so to make big money in the market, you need to take big positions for big moves. I think that our big position right now is still cash, and we'll wade in slowly. But what we don't want to do is be caught in a reversal, because short-term indicators from a contrarian perspective are very negative. The record call buying, the individual investor sentiment. There was even a magazine cover the other day, I think it might have been on Barron's, showing a picture of a bull, some of the contrarian indicators that you would expect to see when a short-term reversal is near. Having said that, this market has broken all records. The bid below the market is very strong. And so we want to participate some, if we can, in a very, very hedged way. So the S&P is up, believe it or not, 15% year to date. The NASDAQ is up 39%. It's just been straight up since the beginning of the year. Counter the old highs are still not breached. It looks to me still like a counter trend wave or a counter trend rally. We have retraced over 78%, which is a Fibonacci number of the decline into the October low. So we'll see. It's possible we could have a vertical blow-off move here, like some are predicting. We're not going to rule it out. And if it happens, we're going to try to catch a little bit of that. But I don't think that our clients and people watching us should expect us to jump in 100%. There's just no way we're going to do that given the macro backdrop. So we'll pick our spots where we can. And lastly, I guess I would just say, if you want to talk, if you want to have somebody to talk to, again, this is all about psychology, and we'll try to do these updates more often. And we're going to post this up to our YouTube channel. Just let us know. Just let us know if you like this. Let us know if you don't like this. We'll change the format a little bit, and even put your questions in the comments section. We'd be happy to address your comments each week as we come back, or periodically as we get a chance to do this. But we just thought this was a good opportunity to get some ideas out, let you know what we're thinking, let you know what we're uncovering as we're researching different ideas. And with that, I think I'll bring it to a close. I wanted to keep this very short. And again, feel free to give us feedback. Feel free to subscribe. Click the subscribe button. This is pretty new for us on this channel, and we'd be happy to answer questions. And we also have live Q&A events every month that are hosted by Adam Taggart, and we'd be happy to answer your questions there. So with that, we will see you next week, and thanks for tuning in.